Okay, stop right there because this is probably one of the most important topics that I talk about. The Federal Reserve came out with a research report, 30 pages discussing about the end of an era, the end of higher stock prices, growth, valuation. Basically giving you a hint, giving you a tip that, hey, maybe stock prices may not go up so much. And if they do, it probably will be temporary because of so and so. Now I'll get into the research report and I'll get into more of this. I'll talk about the highlights. I'll link the research report in the description so you can read up on it as well if you like. Full details are there in the description. Now before I start, my name is Daniel. You're watching InfraVest. InfraVest is an organization that promotes financial literacy, teaches you about the macroeconomics, and also ties it all in with the stock market, the bond market, currencies, forex, and so on. Now, this is going to be a really important video, so if you can share this video with your friends, family, anyone who's interested in topics like this. Hit the subscribe button, the bell icon, and comment also on what you think after you finish this video. Now, let's get into it. I have the report here and I'll start with the title. The title basically says, "The End of an Era, the Coming Long Run Slowdown in Corporate Profit Growth and Stock Returns." I mean, it doesn't get any more clear than this, right? So if there's all this confusion, oh, the Fed doesn't want this, the Fed doesn't want that, this, the market's gonna be fine. Maybe it might be. There's, this whole stock market world is all about probabilities, right? When you're investing and trading, it's all about probabilities. So sure, there could be, some bullish arguments to make. But then when you get the Fed creating a research report like this, makes me think, is the Fed preparing for something, telling us something that we should really know about, that we should maybe pay attention to? So I'm going to go over some key highlights here. So in the beginning, the abstract here, it says, "I argue that the decline in interest rates and corporate tax rates over the past 3 decades is responsible for majority of the stock market's exceptional performance, but that the boost to profits and valuations is unlikely to continue." Right there and then they're telling you that, hey, wake up. The rate cuts, the corporate tax rates, the interest rates that have been going down over the past couple of years, yes, they've been contributing to this amazing growth in the markets and so on. And that's true. If you look at the interest rates and you look at yields, bond yields, they've been going down over years and years, right? There's no more. I mean, just take a look at your own savings bank account. You can't get high interest payments in your savings account. It's really low, right? Maybe back then, maybe 50 plus years back then, you could get higher returns in your savings account or in a bond investment. But today, that is very different when you compare 50 years back. So that's the argument that they're basically starting off with and telling you that, hey, the higher rates that you're seeing in current markets in the economy is unlikely to bring higher corporate valuations and corporate profit as well, which also AKA means stock returns are likely to come down lower as well. Now, it says on page 3, the 30-year period prior to the pandemic was exceptional as interest rates and corporate tax rates declined substantially, which had mechanical effect of significantly boosting corporate profit growth, which I kind of talked about already. This was responsible for over 40% of the growth in real corporate profits. So yes, the lower interest rates, the lower corporate tax rates that were declining over the years, that's what was responsible for this amazing growth in the markets in real corporate profits. Now with higher rates, it's hard to get a proper return or higher, able to make more profits because of the cost of capital, the cost to finance things. You need to be making way more higher returns in order for it to be even valuable for you to invest in. Now it talks about here that corporate profits grew at a robust rate from 1989 to 2019, almost double the pace seen from 1962 to 1989. And this was entirely due to the declining interest and corporate tax rates. So from 1962 to 1989, rates were much higher up there, corporate tax rates as well. But then from 1989 and onwards, this beautiful return in the markets. Yes, we had up and down swings, credit events, recessions, etc., etc. But if you look at the stock market as a whole from 1989 and onwards, this robust rally that we saw in the markets, this robust gain comes from these lower taxes coming down, the lower interest rates that are coming down, that is fueling higher corporate profits. Now it says figure 1 in the report shows that 1989 to 2019, interest and tax expense as a share of EBIT fell from 54% to 27%. So basically saying that EBIT is earnings before interest and tax, and basically saying leaving an ever-increasing share available to stockholders. So these lower, again, taxes and interest rates obviously fueling higher profits. Now this implies interest and tax rates must continue to fall to mechanically boost corporate profit growth, right? So they're saying that, okay, if you want to see higher returns, everyone's really bullish in the markets right now. But if you want to see higher returns, this needs to continue according to figure 1 in their report, in the Fed's report right here. But that's not the case. We're seeing higher interest rates still continuing, not just in your country, globally. There's a global synchronized, the central banks are globally synchronized, they're hiking rates, right? Trying to increase the taxes as well to slow down the prices, the inflation, because it's harming a lot of people. Now it goes on in this report saying, page 4, I argue that it is unlikely that corporate profit growth in the future will benefit much from declining interest and corporate tax rates, because interest rates and corporate tax rates have already fallen to exceptional low levels. And another deficit finance cut in corporate taxes does not appear likely anytime soon. So these profits, the corporate growth that, everyone was seeing in the past 40 years, this is unlikely to continue because we don't see those low level of taxes and interest rates. And the Fed is telling you it is unlikely that you're not going to see this for some time. However, putting an InfoVest twist onto this, we could see that if there is some sort of credit event, some sort of recession, some sort of event that comes in that really screws up the economy and brings in a hard landing, then sure, yes, you're good. You've got enough ammunition, rates around 5%, enough ammunition to do rate cuts, and pump the markets back up. But if the economy is still resilient, growth is still resilient, and the labor market is still resilient, then you're not going to get rate cuts. And if you're not going to get rate cuts, just like this report says, rates are going to be higher, taxes are going to be higher. So how are you going to make those corporate profits? How are corporations going to do well? And how does this justify for higher stock returns? That's what this report is saying. That's what the Fed is saying. Now going on also in this report, says page 6, a longer rate of longer run stock market growth has profound implications for individual investors, corporations, retirement, pension funds, and for the world economy. The historical equity premium is far higher than what could be justified theoretically. Do I need to continue? The Fed is saying here, these are not my words. I didn't make this paper. The Fed is saying here, look, this has profound implications. Individual investors, you and I, corporations, retirement, pension funds, they're going to feel the pain, the world economy. There's no way the stock market can go higher. It's not justified here theoretically, right, for it to go higher. So they're saying that they expect it to come down lower. And if the markets and economy still continues to resilient, then guess what? They will hike rates to try to bring those returns lower. So what I'm trying to argue here, what I'm trying to tell you here, is that just simply reading and listening to the certain research that comes out from the Fed, hearing what they have to say, understanding where they're trying to go with the markets, what has historical data told us. Definitely the Fed can be wrong. Definitely, I could be wrong. Right? Definitely you could have a situation, a Goldilocks situation where the bull market and the markets rally completely. But the Fed and the central banks around the world, but most importantly, the Fed here in this research report is telling you that this is not looking good for individual investors, for pension funds, for corporations, for the real economy. And you're seeing inflation up. Look at UK's inflation level. UK's expected, Bank of England expected to hike rates up to 6% plus. Could that happen in the US? Could it happen in Canada? Sure. If the economy continues to be resilient and inflation continues to move up higher or sticky, then sure, they could either move rates higher or keep rates higher for longer. So this concept of rate cuts, I understand in COVID was an event. 2008 was an event. The dot-com bubble plus the 9/11 was an event. When the stock markets crashed during those times, it was an event that caused these central banks to cut rates. But if there's no event right now, why would they cut rates? And if there's no event, then higher rates for longer until maybe something breaks. And then yes, they'll cut rates. Then sure, maybe another article will come out from the Fed or research report saying that, oh, we see now corporate profits doing well, rates are coming down, taxes coming down, so we see, a nice long run bull market ahead. But with the cost of capital high up there, with the mortgage rates high up there, the yields, the bond yields high up there, the stress in the economy, the pinch that people are feeling, I just don't see how this is justifiable. And forget about my opinion. The Fed doesn't see how the stock market returns are justifiable. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.